It's when we don't know what's going to happen. One day, 150% tariff, next day, 100%, then now 30%, then now 10%. How do you plan?
Welcome to another episode here on our podcast series on YouTube. We're happy to be with you. The Tfteam Dream Team is here, and behind the screen is our executive producer. Stephanie is here with us as
Stephanie
well.
Osorio.
That's right. She's here with us.
Yeah.
And we talked earlier in the week, what's happening in the news. One of the things that was happening is that the Toronto Stock Exchange closed at an all-time high. Now, we've seen a lot of volatility going on. We have seen that in our portfolio. But over the last couple of weeks, things have been said, deals have been made, and our portfolio has gone up by certain amounts of value.
Yeah.
Now, I think back to it. If we had sold those very stocks when it was down, we would have lost or missed out on the opportunity that we are getting now because we've kept those stocks in our portfolio. And I think because I've spoken to you, you know, you lost all your hair in this business. You know what to expect, and you know that these cycles do happen.
Yeah.
And because I was encouraged to keep those, now I'm reaping those gains.
Yeah. So investing is really not a game. It's about planning and planning for the long term.
Yeah.
If we're looking at short-term gains, right, then you know what? Casino, right? Lotto 649 is as good of a bet as anything. But if you are investing for the future, long term, typically they'll say 10 years, but I'll make a compromise and go 5 years. By staying the course, we saw. I mean, not so long ago, the TSX was up only marginally. All the U.S. indicators, the Dow, the S&P, the NASDAQ was down. Stocks were going down. We were freaking out because Trump will say something. The stock market goes down 1% and so on. But what have we seen? Steady as she goes, right? There's ups and downs. So if you are investing, that means you're there for the long term. And the markets, if history is, proof of what will happen in the future, the markets tend to go upward in a 10-year cycle.
That's right. So overall, you should see your portfolio grow. Now, you can't expect that, hey, I'm going to invest today and see a 50% return next year.
No.
It's not likely. The average return is about 8 to 10%, thereabout.
Okay.
It could go lower. It can go a bit higher.
Depending on your risk.
What you have.
And depending on your risk
and
level.
your risk profile. Correct. But you're looking, we're looking at a Canadian index. Why do you think it's up compared to the U.S., that's not been doing so well?
One of the main things about the market, it deals with uncertainty. It hates uncertainty, right? It doesn't matter if we're in a recession or if we are in an expansion. As long as the market knows what the groundwork is, it could deal with that, right? You can still make money in a recession. You can make money when the market, when the economy is in expansion. As long as we know the rules of the game, right? The markets will adapt.
Right.
It's when we don't know what's going to happen. One day, 150% tariff, next day, 100%, then now 30%, then now 10%. How do you plan? How does a business plan when every day the rules change? So when businesses plan for the future, they're not planning for 1 year in advance. They're planning for 5, 10 years in advance.
Correct.
So you're not going to make those long-term decisions when you're uncertain. So you're just going to sit in the sidelines, right? And as a result of that, your company is not growing, your profits are not growing. So if the profits are not growing, then the stock price tends to go down.
So the same, you say businesses plan for 10 years. The same can be for an individual because, this is why I think working with an advisor, whether with our team or
anyone,
or any of your advisors, is important because why you lose your hair when let us lose our hair thinking about the funds that we should buy and the stocks that we should put in your portfolio, because we look at the market because that's our job. We have to look at the news, we have to see what's going on with interest rates, job reports, etc., everything that affects certain stocks and funds. So based on those and based on how we know you as an investor, and of course we're not going to do anything without your permission, but as an investor, we will know how to recommend the funds that are best suited for you and your objectives.
That's
because
right.
your long-term goals are what are important, right? Because if you plan on retiring in 10 to 15 years, or you want to buy a house in 10 or 5 years, then it will have different approaches.
That's right.
And
That's
choosing the right stocks to protect that investment is important, right? And if you want to take a little bit more risk, some people are inclined to do so, and that's fine, because higher risk tends to be higher rewards.
I like the word tends, not guarantees.
Correct. So we will look at that. So we would say, okay, we want to invest in the bank stocks. We want to invest in insurance stocks, because we did see Manulife, Sun Life posting good returns, the bank stocks doing well. But then there's also the other side of the thing.
Well, the Magnificent Seven are doing better again.
Yeah, they're
right?
doing better again.
So
yeah.
so here's the thing. Here's what I look at. I tend to be a bit more conservative in my investing as I get older. Oh, I lofted it for you. I thought you were gonna spike it down. But here's the thing: our economy is going, we're seeing that the U.S. They're slowing down. Right,
Yes.
their economy is
Yes.
slowing down. They're not in the negative. They're not growing at the same rate. Inflation is down in the U.S. So the U.S. Federal Reserve, which is their central bank, they're poised to lower interest rate.
Right.
So which type of industries tend to do better in a slow growth, low inflation, low interest rate environment? Typically financial services,
Yes.
right?
Yes.
And we've seen TD, right? We were lucky that we got into TD early, but from the time I started looking at it, it was at a low of $78,
Yeah.
and then now, as of yesterday, it peaked at over $90.72. So this is not. We're not advocating purely TD. This is being replicated with all the financial services stocks, such as banks and so on. So why not benefit from this low interest, low inflation, slow growth environment by maybe putting money into an investment that will provide you with potential growth, but steady income, right?
Yeah.
Because which companies year after year generates profit after profit, record profit? Those are the banks.
Financial services, yeah.
Why not, if you can, buy one stock a week or one stock every 2 weeks of one of the banks? I'm not saying that you'll be rich.
Yeah.
I'm not guaranteeing that you're going to make a lot of money, but at the very least, you will benefit from the dividends that are being provided on a quarterly basis. And what do you do with the dividends? You buy more stock.
That's right.
With that, you reinvest.
And you look at that every 2 weeks. You get paid every 2 weeks, and you have a PAC, a pre-authorized contribution from your paycheck goes directly to purchase a part of a mutual fund or a segregated fund or a stock.
Yeah.
That adds up,
Big time.
and then by the time it matures, so let's say 10 years or 15 years, when you retire, or even not retire, maybe you want to do whatever, travel, etc. That interest, percentage-wise, that you're going to get from those dividends is probably equivalent or even greater than the savings accounts that are being offered by these very institutions.
Big time.
Right?
Well, let's just do a quick illustration.
Yeah.
Let's just say we buy one stock, right? Let's say it's TD, right? Once a week, $90 right now, right? It probably will fluctuate.
Right.
So $90, so $90 on a weekly basis, right? We buy one stock. So that's 52 stocks, 52 shares of TD, right? For 1 year. multiply that by 10 years, you would have owned 520 if you didn't increase,
Yes.
right? So 520
Mm-hmm.
multiply another 10 years, so 20 years. Now we've got well over 1,000, right?
Yeah.
Now, could you imagine what the dividends will be, right? On a quarterly basis, right? So you could replace your employment income with the dividend income, and guess what? Tax free because it's in our TFSA. It's not employment income. Now, this is one stock, all right?
Correct.
So most advisors, if not all advisors, are not going to tell you to put all your eggs into one basket,
Correct.
even if it's TD or Royal Bank, the biggest bank in Canada. Then why not diversify and put your money into a Canadian dividend fund? So now you don't just have TD, you've got all the banks, insurance companies, and others that have been consistently paying dividends. So now you're getting dividends from all various companies and industries. And again, you could do this on a weekly basis inside your TFSA and then reap the rewards 5, 10, 20 years or when you retire.
And you say you can open a dividend fund, but let's say you have a couple who comes to you and they want to invest, right? They want to open their TFSA, and let's say one spouse is aggressive, one is conservative. Well, the conservative spouse, they'll get the dividend fund. The other spouse who's aggressive, they'll get the equity fund. You've hedged against the couple, and they protect their investments. So they're going to get income plus they're going to get growth.
Exactly.
And that's why you work with the Tfteam.
Exactly. Oh,
because we see the big picture. We see the big picture that's out there, right?
You scare me.
We
with
go
the hints.
all the way
You're scaring
to the
me.
Middle East to get the big plane and get the big picture.
Oh,
so we can see the big picture.
You had to tie that one with Trump, right? With the new plane. I never know where you're heading.
You see, what we're heading is for what's best for our clients.
That's right.
Right.
That's right.
And we need to have that. Sometimes we don't see it because we're looking at our end goal, but we need to just come out a little bit and have a perspective of where we're heading. And that's where a second pair of eyes,
that's right,
or like in my case, 4 pairs of eyes can help, right? So that's why you need to contact the team, right?
Yeah, exactly. And if not the team, then your particular advisor. One of the things I say, if you don't have a plan, whatever plan, then you plan to fail, right? Because who goes into business without a plan?
Yeah. You're the man with a plan. Season 1, episode 5. All right. So thank you so much, the man with a plan. That is it for us today. We will be back, of course, with a brand new episode next week. Thank you for watching. Like, subscribe, share, and of course, we'll be providing more tips as always. And we've got our guy here on the left of me with all the plans for you. Take care.
Take care. Bye.